I'm joined by Liz Moran from FIIG Securities. How are you, Liz?
Great, thanks, Andrew.
So, look, you've got the incredibly sexy world of bonds to discuss and how they can stabilise your portfolio. Do you find that most people look at bonds and go, "Wow"?
We wish
is
they
that the
did.
I know, but is that the
No,
sort
they
of
don't.
is that the sort of reaction that they're possibly not as interesting or as exciting as other investment opportunities?
That's what everyone thinks,
Yeah.
but actually they are fairly sexy and they can be very exciting. So you can make higher than expected returns on bonds. People don't realise that. And there's a lot of opportunity out there. So we're just trying to today and over the course of the conference get the word out that bonds can be a very exciting asset class.
Okay, so what's the fight that you're experiencing or the reaction to talk about bonds? Like, why is it so difficult to make them as exciting for everyone else as they are for you guys at FIIG?
Okay, I think a lot of the reason is that a lot of the commentary in the press has been around US Treasuries, which are earning very low returns. Risk is all on the downside and possibility of losing money if interest rates rise. But that's not the case with Australian corporate bonds or other international corporate bonds. So I think there's just a few myths out there that make bonds seem unattractive at this point in the economic cycle, but they actually can be very attractive.
Okay, as a tool to stabilise your fund,
Yes.
how does that work?
Okay, so bonds in terms of risk and in terms of return sit just under term deposits in a capital structure. Now, I can explain that at length, but I won't now. But what it means is that you earn more than term deposits, so your return's higher, for a small increment in risk. But a bond is a lot like a term deposit in that you are lending the company your money. So like a term deposit, you lend the bank your money. The company agrees to pay interest on set dates and return your principal on a set date. So it is a contractual obligation. They cannot not pay the interest or the principal when they say they're going to.
Yep. So you know exactly what you're going to get.
You know exactly what you're going to get. Great for people planning on retirement, wanting an income stream. And there's a number of other protections bonds have over term deposits.
Yep.
So, for example, there are fixed rate bonds. These bonds really outperform when interest rates start to decline because the bond price, the only way the interest rate change can be reflected is through the bond price. So the bond price moves higher. So you can actually get higher than expected returns.
Yep.
An example at the moment would be a Stockland 2020 bond. So all bonds are issued with $100 face value.
Yep.
But when that bond was issued, it was issued with a high interest rate. As interest rates have come down, investors have been prepared to pay more to access that income stream. So the Stockland bond, for example, now is trading at about $115. So had you bought that at first issue, you've got the $15.
15%, yeah.
Exactly. Yeah.
Okay, it's still not sort of in that sort of exciting. And don't misunderstand, right?
No.
So, like, I can't imagine many people are going to go, "Oh my God, I just made 1.7 million. I just sold. I bought at the bottom. I sold it." You know, there's not that sort of, I suppose, braggability about bonds. Or there doesn't seem to be the braggability around bonds that there are in say, normal share trading.
Look, I think that's part of the beauty of the asset class, in that you know what you're going to get. That you don't have to wait and sell, or if you came and saw FIIG today, we could give you projected earnings for the next 12 months. You don't know what's going to happen to the share market, or the price of the shares, or the dividends for that matter. So bonds, the certainty is attractive. You can make a lot higher returns than what you expect.
What sort of weighting would you like to see in a trustees fund, basically with shares, bonds, housing, real estate?
Okay. What we like to say is investors should own their age in bonds. So if you have a 70-year-old investor that are in retirement, they need to be really protective of the capital that they've built up, because they have no chance to recoup the losses through other sources. So we say own your age in bonds. Bonds are very low risk, very low chance of you losing money. Generally in Australia, nearly all the investors are investment grade, so there's a lot of comfort there.
So for instance, I would have then 47% in bonds. Is that what you reckon?
Well,
so I'm 47, so I would have around half of.
Yes.
That would be your.
Yes, that would be
And
our,
it seems like a lot.
suggestion. But I mean, you have to think if you suffer a shock now, if there's another shock in the share market,
Yeah.
are you prepared to lose 50% of your capital at this point?
Would never happen, mate. They've had it, mate, already. It's gone. Liz, great to chat. Thanks for your time today.
Thank
Good
you.
on you.
Great. Thanks.